The new Income Tax Act 2025 introduces a comprehensive, consolidated statutory framework for business taxation and compliance in India. This session focuses on one critical mechanism within that framework, the statutory application of depreciation. For decades, tax professionals relied on Section 32 of the 1961 Act. That provision has now been entirely replaced. The new governing provision is Section 33 of the Income Tax Act 2025. As we see on the cover of the Institute of Chartered Accountants of India's BEAR Act, this falls under Chapter 4, which governs the computation of total income. We will break this down into three core elements: the primary conditions for claiming the allowance, the exact block-wise rate structure, and the critical new 40% capping rule. We are bypassing general summaries to provide a precise clause-by-clause derivation of the law as written. Mastering this specific section is required for accurate corporate tax planning in all upcoming assessment years. Understanding Section 33's rigid architecture is the absolute foundation for protecting a company's capital expenditure under the 2025 regime. Section 33, subsection 1 is the absolute legal starting point. It sets the baseline criteria for claiming any depreciation allowance. The first mandatory condition is ownership. The tangible or intangible asset must be owned, either wholly or partly, by the assessee. The second condition is utilization. The asset must actually be put to use for the purposes of the business or profession during the tax year. A statutory caveat exists in Section 33, subsection 3, Clause B, for assets that are only partially used for business purposes. In these scenarios, the assessing officer has the explicit authority to restrict the deduction to a fair, proportionate amount based on actual business usage. Once the right to claim is established, we move to the mechanics of how the actual quantum is calculated. Look at this conceptual model representing Section 33, subsection 3, Clause A. The Act mandates a block of assets mechanism. We do not calculate depreciation on individual disparate assets. They are mathematically merged into a unified category. This block is calculated strictly on its written down value, or WDV, rather than the original historical cost of the assets inside it. Section 33(1) grants the basic right to depreciation, but Section 33(3) dictates that this right is executed collectively through a strict WDV-based block of assets system. While Section 33 provides the legal mechanism, we have to refer to Appendix I of the income tax rules to find the exact depreciation rates. This rate matrix categorizes assets by block. The first major block is buildings. The rates are segmented by use: 5% for residential, 10% for general commercial, and 40% for temporary structures. Next is the furniture and fittings block. This block carries a flat 10% rate applicable to all qualifying items. Then we have the most complex category, the machinery and plant block. This differentiates between a general 15% rate for standard plant machinery and an accelerated 40% rate for specific items like computers and pollution control equipment. The remaining specialized blocks are ships, which depreciate at 20%, and intangible assets at 25%. But identifying the correct block is only the first step. There is a specific legislative restriction regarding maximum allowable limits. The new tax regimes impose a universal 40% capping rule across the board. Historical high-rate blocks, which previously allowed 60 or even 100% depreciation in a single year, in compliance. After determining the rate, a temporal filter must be applied based on when the asset entered the business. This is governed by Section 33, subsection 4, commonly known as the 180-day rule. Look at this timeline. Section 33, section 4 contains a dual trigger condition. It applies only when an asset is both acquired during the current tax year and put to use for less than 180 days. If both conditions are met, the consequence is strict. The standard prescribed block rate is immediately restricted to 50% of its normal value for that year. Now, let's carefully layer in the specific, powerful statutory incentives provided for manufacturing and power generation assessees. These industries are subject to Section 33, subsection 8, which governs additional depreciation. Installing brand new machinery and plant grants these specific businesses an extra 20% depreciation allowance on top of the standard rate. The complexity arises when the 180-day rule of Section 33(4) collides with the additional depreciation of Section 33(8). If that new qualifying machinery is put to use for less than 180 days, the additional depreciation is halved. You only get 10% in the current tax year. However, the remaining 10% is not lost. The statute explicitly allows it to be carried forward to the immediately succeeding tax year. Year-end capital expenditures must be precisely timed. Acquiring and deploying an asset late in the financial year determines whether the immediate tax shield is reduced by half. Let's pull back and review the complete end-to-end depreciation engine under the 2025 Act. As this flowchart shows, Step 1 is to correctly classify the newly acquired asset into its appropriate Appendix I block. Step 2, verify the exact date the asset was put to use to navigate the 180-day hurdle in Section 33(4). Step 3, ensure the final calculated rate does not violate the 40. This carried forward amount is legally treated as part of the depreciation allowance for that succeeding tax year, blending into the next calculation. The Income Tax Act 2025 simplifies the language of the law, but it maintains a rigorous mathematical structure. By mastering the block classifications, strictly monitoring deployment timelines, and applying the rate caps, practitioners can confidently execute Section 33 and safeguard capital investments.